Hi, class. Let's start the chapter. Okay, today we will talk about chapter 6. We will leave chapter 5 until end of the semesters if we have the time. Now, in the chapter 6, what we're going to do a firm's production decision and cost in the short run. Now, in this, what we're going to learn is we're going to explain what a firm is and list of the types, list of different types of firms. Describe how and why economists and accountants measure cost differently and distinguish between the accountants and the economists' view of profit, and explain the crucial relationship between productivities and cost. Also, we're going to demonstrate the important difference between the fixed costs and the variable costs. We're also going to list and graph 7 specific cost definition used by the economists and explain the meaning of increasing productivities and cutting costs also. So there is a different type of companies. In general, there is some kind of company called or a firm called the role of the firm as a sole proprietorship, whose owner or manager is responsible for all the activities of the firm. So it is like a part of his operation, and it's part of if he make a profit, it's going to be if company if the firm makes profit, it's going to be his profit. If he's lost, is they have to he has to pay for the debt. Then you have what you call the partnership, which has two more joint owners. And in a limited partnership, some of the partners have no profit in running the firms and are not liable for the debts. And here where they will be after establishing partnership, they will be dividing how many percentage who owns what and who is liable for what. So the third type is the corporation where whose the owners are not personally responsible for the debt. So if it goes bankruptcy or loss, it's not responsible for the debt and not personally involved into operation. There was different people operate in it. And that's what you see the stocks and shares and all these things. And then you have the state-owned enterprise, which is in Canada, what they call Crown Corporation in Canada, and which is owned by the government and generally run by appointed officials. I know there's like the landline, the post office, the trains. They are all corporations, CNN. They're all corporation, Crown Corporation included. And then the last one, what you have is what you call a non-profit or organization, and you're probably aware of them, which is organized to achieve certain goals by providing good and service, but not with the intention of making a profit. There could be any other intention that they have in their mind. So, what's a production? Production is the activity of a business organization or a firm using inputs to obtain output of some product. Basically, you have an input like a sand, gravel, cement, water, machine, and labor. And through the production process, what you end up with the output, which is a concrete. But these inputs has a cost in them, and the payment of the input is called cost of the production. Now, the explicit and the implicit costs, and that's where it comes in the difference between the accounting approach and the economic approach. The explicit cost is the cost that is, excuse me, a cost that is actually paid out in money usually is the non-owners and to the non-owners. And the implicit cost is the cost of using the owner's resources that does not require an actual expenditure of money. It's like, you own a company and you work in it, and it's your company, so you're not spending money there, cash, to the third party or somebody else, non-owner. Now, if we look at it, you know, usually what you call in the accounting approach is what you call it explicit cost, but in the economics is explicit plus implicit, or cost of opportunities another way. So in the total cost, total revenue in the accounting approach, total revenue is like say 220,000, and the rent 15 you paid 42 for the suppliers, utility 1,000 you paid, you hired laborers for 1,000, $10,000, and depreciation of your equipment is also. So the total cost is 1720, and you made a revenue of 20,000. That's your accounting profit is at $2,800. Now, in the implicit, what do you do in a economics approach? Is you calculate also the implicit cost, which is the opportunity cost, how much you invested, put into business. So if you put $96,000 that month or that year or whatever, it is $800 opportunity cost there. You could have had it in the bank and made a interest rate, for example, and the labor put in by the owner. And we said in earlier that if you're a owner of the company and you work there and you don't take a salary, that's part of the implicit cost. So the total implicit cost is at $4,800 plus the explicit cost, which is 1720. So when you make a revenue of 20,000, actually you made a loss of 2000, because implicit cost plus explicit cost becomes at 22,000, and you made the 20,000, so you lost 2,000. So the economic approach is that you're losing it to $2,000 because you calculating everything, including the implicit cost. You don't pay it for the third party, you use it there. Now, accounting versus economic profit. Accounting profit is, as we said, is the total revenue minus the total explicit cost, the cost that you pay for the third party. In the economic profit is the total revenue minus the total cost, which is it's the same thing, but here when you add implicit and explicit. So your total cost made of implicit and explicit costs. And if you look at it here, another example to look at it differently, say in the economics view, in accountant view, your revenue is at 25,000, your explicit cost 17,200, so you end up with a profit of 780. On other hand, in the economics view, you're still investing 25,000. There is the same explicit cost here, but there is a part of it where you have put some work, but you didn't run any salary for yourself, or you brought your family working there. So that's another $4,800, plus maybe the opportunity cost that you lost. You could have had your money in the bank, all these things. So your a profit here is economic profit is only 3,000. This is the different approach for this accounting. So what we're looking at something called a normal profit, is the minimum profit that must be earned to keep the entrepreneur in that type of the business. That's what you call a normal profit. Then you got the economic profit, is the revenue over all above the cost, including the normal profit. That's another way of looking at explicit and or versus explicit and implicit. And then when you have something called the sunk cost, is the historical cost of an asset that are unrecoverable, or depreciation cost in the accounting. That's what they call it. It's called here a sunk cost. So we will, the theory of the production is about any period of time in which at least one input in the production process is fixed, because you need to look at the variable costs and all other things. So one cost is fixed, like a rent. Uh, the total product is the total output of any productive process. So whatever is your process, your corporation, your manufacturing, whatever your service, the total output is of any productive process. So the theory of production, there is what you call the marginal product, the increase of the total product as a result of adding one more unit, like one more labor, for example. When you add one more labor, you notice that if you are moving these stuff around, and if you add one more person, things will move faster, for example. So the increase of product as a result of adding one more unit of input. And it is marginal product is equal with the changes in the total product over the changes in the labor. And we said is if you has one more, it's going to take you half an hour, but if you are only two per people, it's going to take you 1 hour. If you add one more, it take you half an hour, for example, something like that. Then what you have is called the average product. And the average product is the total product or the total output divided by the quantity inputs used to produce the total. So you have 10 units of bricks, 10 units of wood, 10 units of some, so, I don't know, whatever. You put them together and you make a small house. So it is the total product or the total output divided by the quantity of input used in the produced. So let's assume you put 10 units in and you produce a 12 units of something. So it is, uh, we're not going to use the dollars here, but it is 12 over 10 is 1.2, something like that. Then what we have is law of diminishing return. A more of a variable input is added to a fixed input in the production process, the resulting increase in the output will at the same point begin to diminish. So let's assume you put one variable good and one fixed good, and you have your output is two. If you put two variable good, and always there is a one fixed good, their output is three. Three variable goods and one fixed good, it's going to be out. So it's increasing, and as it's increasing, it's diminishing. That's what you call law of diminishing return. So the more variable goods you put, the more variable units you put, the more you produce up to a one point and start diminishing after that. In the division of the labor, the dividing the production process into a series of specialized tasks, each one done by a different worker. So this person will do this thing, A, B, C, D, each one will do differently the work. Now, the benefit of division of labors, why we divide people, at work, is the fact that is the ability to fit best person to the right job. So you need a very strong man to carry things around, but you need a very, uh, knowledgeable person to put these things in the house, but a very strong man to carry things. This. That's one example. Increase the skill and creativity achieved when one worker focus on a one single operation. When you're focusing on one thing, it's very easy for you to start become a creative of finding a best way and a fastest way to produce. You're also going to have some time saving from having to change from one job to another or switch the tools and all these things in the machine. Time saving gain from moving from one operation to another operation, resetting the operation, and machine specializing can be developed around a specific discrete operation. This machine produce certain units and will be specialized in producing that so that there is no reset changing the input or stopping and switching the machines, so that's more becomes more specialized and more productive. But and if we look at this graph, it's a little bit confusing in the beginning, but if you look at it, it's pretty much straightforward. Average product will rise if the marginal product is above it. So if you notice here, what we have, uh, and fall if the marginal product is beneath it. So here's the average product, it keeps going up and it goes at the highest point. And as it at the maximum point, then you start declining when it becomes under the seven here, the unit, because you have more labors than you need. So it is the point of maximum total production as increases, but once it goes below the zeros here, you will have a declining here. On this case, for example, if you have so where is, the intersect between the two graphs is the point of maximum productivities. So we have the point of maximum productivities, which is a point of diminishing return. There where we start having less productive, not diminishing in number of units, but the same average person is producing less. Let's just put it this way. You notice after 6 hours, people will produce less. I mean, from 1 to 6 hours, they're producing better and stronger. That's they did not stop, but they have produced after 6 hours less and less. And that's when they start the diminishing return. So when it comes to 8 hours, they're really tired and they start not producing or really going down with the production. And instead of, they will stop going down. So you need to look at the point where they intersect here. That's where the best, point of maximum productivity is. But the most important that you need when you look at the labor, where is the peak level they can produce, and then they start, the number that they produce per unit of labor becomes less and less. Now, what you have, there's something called the marginal cost and the variable cost. In the marginal cost, production relates to the number of units produced to the amount of a labor used. Cost or relate to the number of units produced to dollars. Cost depend on the level of production, how many workers, and the level of the total product. So let's say the marginal cost is the fact that if you put one more labor, this is what you call the marginal, or the extra cost that's happened. That's marginal cost from the previous point. And then you have what you call the variable cost, is the total units or the units that you put in beside the labor or whatever divided. This is like the unit you put in, how much is you producing. You have what you call a total cost, and total cost made of two things. The fixed cost is like the rent. Then you have the variable costs, like bringing one labor, bringing oil, bringing weeds. That's a variable cost. So the variable cost is really the labor, or put it this way, the wheat, the oil, because you want to produce a bread. But the fixed cost is the one that you have to pay it, is a rent, whether you're operating or not. So the costs depend on the level of production, how many workers or how many, you know, wheat or oil you need, and the level of the total product compared to the level of total product. So the total variable cost is the total of all costs that vary with the level of output. And we said if you want to produce three bread, you bring 1 kilo wheat, flours, and 1 kilo oil. I mean, 1 liter of oil, and thus you produce three bread. Let's assume. But if you want to produce six bread, then you bring instead of for 1 kilo of flour, you bring 2 kilos, so your variable cost went up, and 2 liters of oil, so your variable cost went up. So the total, when you add all these variable costs went up, the ones all together, that becomes a total variable cost. On the other hand, we said that if you increase 1 unit, how much extra cost is going to cost you need to put in is called the marginal cost. So the increase in the total variable cost as a result of producing one more unit of output, and we brought the example of flour. You bring 1 kilo and 1 liter to produce three bread. You bring 2 kilos and 2 liters to produce six bread, for example. That's what you call the difference. That's the difference is the marginal cost. So the marginal cost is the change of total variable cost, the difference of this situation, to over the total output, the change of total output. So the change of total variable cost over the total change of output is what you call the marginal cost. You need to know that because you need to do the calculation if you're an economist to see whether should we add more production, more variable costs, or where we should be stopping as a variable cost when it comes to the diminishing returns. How you do the average variable cost is basically total variable cost divided by total output. It's just how you do it. The average fixed cost is the total fixed cost divided by total output. And how you do the total average cost is you do the total cost divided by the total output. So total fixed costs, costs that do not vary, we said as a rent, costs that do not vary with the level of output. And we said the average fixed cost is the total cost of total fixed cost divided by the quantity of output as you see it in the formula here. AFC, average fixed cost, TFC, which is total fixed cost, total output. To do the total cost, we know that the total fixed cost plus the total variable cost. So you know, your fixed cost is your place and the cooking stuff that you have to buy, whether you're going to cook or not. And your variable cost is probably the flours that you bring in, and how many kilos of flours and how many liters of oil. But the average total cost, as we said, it is the total cost that you have divided by the output. And you know, the total cost is made of fixed costs and variable costs. Now, we said in the marginal cost, said that the two changes in the total variable cost, when we add one more unit, over the total output. And since the fixed costs do not change with the output, the total cost will change as a variable cost do. So in other words, because the fixed cost stays there and the variable cost changing, but your output is also increasing, so your marginal cost keeps going up, but sometimes it will be declining because the more you put unit, the less numbers you produce. That's where your marginal costs start diminishing. But the overall, you need to remember the marginal cost is change in the total cost, which is made of fixed costs and variable costs over the change of the total output. So, and we're looking at it in general. For example, if you have the total fixed cost, which is TFC, divided by the total output, you have what you call average fixed cost, because here's a fixed cost, output, average fixed cost, plus the total variable cost divided by the output, you have the average variable cost. And you know total fixed cost plus total variable cost, it will result in the total cost. So the average fixed cost and the average variable cost will also result in average total cost. The marginal cost is the change of the total variable cost or the total cost as a result of one more unit add there. As the marginal costs intersect with average variable cost and average total cost as their minimum. So if we have the marginal cost, and you know the fixed cost is going to keep declining, doesn't matter how many you produce, the more you produce, the less your fixed cost goes down. But the variable cost, it keeps going down until we reach to a point and start going up because, maybe the people are not, getting tired or the machine breaking down more often and you need to fix it. So these are things, or you need to, in nighttime, the more electricity spend or something. These are variable costs that after a while start increasing per unit. So you need to distinguish between variable cost as total variable cost and the average variable cost. The total variable cost will be increasing as production units increasing. But the average variable cost as a beginning start declining, and then when it reaches to a point diminishing, it start increasing because we said maybe it becomes a nighttime, you need electricity, we put too much pressure on the machine, it breaks or needs more oil or something like that, or gets older, something like that. So here, the average fixed cost is always declining, if you notice. Then what you have what you call the, sorry, the the marginal cost, it keeps going down, as we said, as the average variable cost also keep going down. But at this point, when the average variable cost start increasing and the average total cost start increasing also, so that's where you need really to look at, that's what you call a best output at, which is $14.03 units. Now, in the case where the average total cost, this is you know, your last top reduction at the average total cost here, which is the marginal cost increases. So the no point B. Now, so in the when it, when we look at the Q1 is a point of diminishing return where the MC is marginal cost is at its lowest. So we said that the diminishing return comes in here and start the marginal cost increasing. As the marginal cost start increasing, that's where the point before it is what you call the diminishing return. Now, what you have at the Q2, which is the quantity output of Q2, is the point of the most productive output, whereas the average cost is the lower. So here, where you have the lowest average cost, and we said fixed cost stays there, but the more you produce, your total variable cost, total fixed cost stays there, but as more you produce, your variable your fixed cost per unit keep reducing, but you have to notice your variable cost as your production start producing keep going down, because now you can, instead of have one person do one two things and then stays idle for half an hour, he is busy of doing so, you're producing more on this variable cost person that you bring in to work. So it keeps, as the variable costs keep decreasing, it's good for the business, which is the marginal cost keep increasing. But the minute is the variable cost start increasing, that's where you it starts getting bad for the company, and because the marginal cost start increasing by increasing one more point. In the Q3, this is economic capacity where average total cost is at the lowest point. Average total cost, because it's you have a, say, a place of 1,000 square meters, and this is the average fixed cost, and you have a machine that takes a 200 square meters only. So you have lots of space and you're paying lots of average fixed costs. But if you have more machines there, is more occupied, you can rent it out, more occupied. So that's, if you have the fixed cost fully utilized, that's what you call the economic capacity. That's cannot have more than 10 machines in a 1,000 square meters, for example, and that's having 10 machines. That's the full economic capacities for the fixed cost. So what we have here, we have something called total cost. And the total cost, as we said, is made of total variable cost plus the total fixed cost. And we said that the total cost always constant. A rent, whether you work there, you produce or not, is fixed. And then the total cost starts at total fixed cost, because we said you're not producing, but you have to pay $1,000 of rent. That's your total fixed cost equal with your total cost. As you bring people to work, as you bring more, flowers, if you bring more oil, that's a variable cost, so your total cost will change. But the total variable cost start as zero because you're not producing, since there is no variable cost when there is no output. As the total variable cost increases, as we said, you bring more flowers, you bring more people, the the fixed cost is always there. You add the total variable cost, and as the total variable cost increase, the total cost increases the same amount. So you notice here, as we start up, we have a fixed cost, doesn't matter what we are doing, and your total fixed cost is there if you're not producing anything. As you start beginning, then at this point, when you start producing total variable costs, start with the you buying thing and start, producing, you add this, here is equal, but this area plus this area will give us what? A total cost. So the distance between the total cost curve and the total variable cost curve is the constant fixed cost. That thing will change per if you think in variable, but here, if you think in per unit, which is the average, here is we're talking about the total fixed cost and the total variable cost and the total cost. And here where economists and businessmen decide to cutting the cost. Cutting the cost involve a reduction in the average cost rather than the total cost. Because you rented the place, so you do first step when things slows down, you let the employers leave, you buy less flowers, you buy less oil. So you're cutting in your cutting costs involved in the reduction of average cost rather than the total cost. Now, the firm is assumed to be producing at the lowest possible cost for each output level. We assume that. We assume that's a very as the lowest possible cost. Now, the average cost will decrease if the price of fixed and variable input decrease. So the less we put in, the less average cost becomes. The less flowers we buy, the less average cost it becomes. The technology improvement caused the marginal product of a productive process to increase. And we brought this example in the early chapters, a shift out and a shift in because of the technology. Because with the technology, the cost of production goes down and the cost of production goes down. So the because of the average cost is going down. And the third possibility is a firm is operating at the excess capacities and then increase output, or is operating above economic capacity and decrease the output. You have a machine that's supposed to work 10 hours a day, and you're operating it for 15. The break more. So you need to fix, and it's going to cost you more. So you need to decrease the output. And because you are operating at above the excess capacities. And if you have a machine that doesn't work 2 hours and supposed to run 10 hours, you increase the capacity, you produce more, then you are increasing the output. So a shift in the marginal and average total cost. If the input prices decrease, the cost will shift down. Basically, we said if there is technology improvement or the cost of input, the prices goes down, what will happen? You will be having the average total cost will be shifting out because your cost is lower. Now at the same, you can produce more unit. So your marginal cost also is going down because all your cost that you're putting it in is going down together. So lower the input prices, shift the cost curve down more. So it goes from average total cost one to two, which is that your total cost goes down for producing, so it shifts more, and you're willing to produce more. So some of the key concepts that you need to remember is the distinction between the implicit and explicit cost, the difference between the normal and economic profit, and normal difference between the accounting and the economics calculation, the product, average product, the marginal products, the difference between them. Think distinguish between what's a total cost, average cost, variable cost, total variable cost, average variable cost. These are makes a distinguish between them. We spoke about the division of labor and law of diminishing return with the marginal costs keep going up. Then when is people are really getting, for example, tired and they're producing less unit per that hour, per certain hours. Then we spoke about the total cost, variable cost, and fixed cost, the various relationship, and that's it.